A home is the best investment you'll ever make. Or at least that's what we've been told. But is it really true? Once you account for all the variables, is your home really a good investment? Well, it depends on how you approach it. So let's talk about it.
But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today.
So in order to figure out whether the home in which you live is really a good investment or not, it helps to know what a good investment is. And please note that I said the home in which you live. We're not talking about investing in rental properties, or REITs, or apartment and commercial buildings today. We're specifically talking about your personal residence, because those other investments are very different and would really deserve their own videos. So I already covered what I consider to be the 4 major keys to successful investments in last week's video, so I won't be spending too much time on explaining that today. If you missed that video, I'll leave a link to it in the description below so you can watch it and get caught up, but the extremely simplified version of it is that the ideal investment generates high returns with minimal risks and costs to go along with a few additional perks that may or may not be financial in nature. Once we know what makes an investment good, we can then compare each investment we're looking at to alternatives to make sure we're making the best possible choice. So with that in mind, how do homes stack up against other investments, such as stocks? Well, let's take a look at the history of the typical home and the stock market to see how they compare. First, let's start with returns. I'll be using the Case-Shiller National Home Price Index to estimate the average returns on a home. For those who don't know, the Case-Shiller Home Index tracks repeat sales of single-family homes nationwide going all the way back to 1890, and it's already been adjusted for inflation, using the CPI to measure inflation. Since the index tracks repeat sales of single-family homes to get its price, we won't have our numbers influenced by the sales price of brand new custom-built homes. This is important when looking as far back as 1890 because new homes being built in 1890 were quite a bit smaller on average than the new homes we're building here in 2019 and 2020. So it stands to reason that the prices of the newly built homes today would have grown a bit faster because they're bigger and cost more to produce. We also won't have our returns altered by the sale of commercial buildings, apartments, condos, or multifamily properties. Lastly, the index only counts arm's-length transactions, which simply means that most sales below market value, such as those sometimes conducted between family members, are not counted. However, foreclosure sales between banks and individuals are still counted. What this index doesn't do is adjust for the costs associated with investing in a home, so we'll have to estimate those as we go along. The index has a normalized value of 100 in 1890, and as of this writing, it is valued at about 174. Inflation has been about 2.62% a year over that time. This means that over the course of the last 129 years, nationwide, the average single-family home has grown by approximately 0.43% per year after inflation, and before adjusting for costs. Assuming you don't rent out rooms, or do something else to increase your returns, this is essentially what we've got. Next, let's look at the costs of a home. As I detailed in my video on the true cost of home ownership, there are upfront costs and ongoing costs to owning a home. These costs vary depending on how much money you put down for the home, how much you pay in closing costs, and what kind of repairs or remodels you end up doing. But if we assume that you put 20% down and paid 5% in closing costs on a $200,000 home, you'd pay $50,000 to get into that investment. If the home appreciates at, say, about 0.5% per year after inflation, it'll take about 9 years for the real value of the home to recoup just those initial costs. If we take that into account, along with what your closing costs would be to sell the home, it would be even longer. What's more, as we detailed in that previous video, those aren't the only costs. If we assume that the ongoing costs of the home are roughly 1% of the value of the home each year for maintenance and repairs, another 0.75% for property taxes, and 0.5% per year on insurance costs, then we'd be spending the equivalent of about 2.25% of the home's value per year in ongoing costs. If we assume about $250 a month for all utilities, we'd tack on another 1.5% to our total costs, giving us a grand total of about 3.75% per year. All those costs are going to rise over time, either with inflation or with the value of the home, and mind you, that's before considering the mortgage payment, which would be about $810 a month, assuming our 20% down payment and a 4.5% interest rate on a 30-year loan. When we put all this together, this may actually give the average single-family home a net negative return after inflation and costs are all taken into account, using these numbers in this time frame. In this particular case, the average annual rate of return would be about negative 3.25% before adding in the mortgage payment. If we were to add that in, the final return would be likely somewhere in the negative 7 to negative 8% per year range for the 30 years that the mortgage is being paid. Unfortunately, I don't have access to data on the S&P 500 from 1890 because the S&P 500 didn't exist that far back, and index funds that we can actually invest in are even newer, with the earliest data that I have at the moment going back to about 1980. So to compare apples to apples with the stock market, we're really going to have to recalculate the data starting from 1980. Thankfully, this actually helps the home's returns out a bit. Since 1980, inflation has averaged about 2.96% per year, and homes have appreciated by about 1.52% per year above that, or about 4.5% per year before the costs of inflation. If we assume that our costs are about 3.75% per year without the mortgage, then our net return after costs and inflation is about negative 2.25% per year. For the S&P 500, we'll be using data from Vanguard's S&P 500 Index Fund, ticker symbol VFINX. It has an expense ratio of 0.14% per year, so those are our costs. Assuming we reinvested all the dividends we earned from the index fund, then after adjusting for inflation and costs, our net return would be approximately 7.41% per year. That's quite a bit better than the home's net return, so I'd have to give the edge in terms of return and costs to the stock market, at least assuming you didn't do something to generate greater returns from the home, such as renting it out while living there, or save enough in taxes to be able to invest extra in other places and make up the difference. But with that being said, let's move along to risks, because there are risks associated with both investments, as I covered briefly in last week's video. Both can have swings in value from time to time, and both can experience crashes every now and again. This not only exposes you to volatility risk, but also can leave you exposed to horizon risk. Both homes and stocks can be exposed to leverage risk, with homes being almost always exposed to it if you don't buy them with cash. Financial literacy risk can be an issue if you're unfamiliar with the area you're buying a home in, or if you aren't fully aware of the ongoing costs and effort required to maintain a home, but the same can be said if you're unfamiliar with stocks you're investing in. And depending on your risk tolerance and what you do and don't enjoy doing, satisfaction risk could also become relevant to both investments. After all, owning a home takes a lot of time and effort to maintain, which some people enjoy and others don't. And what's more, the day-to-day volatility of stocks could create more stress than other investments would, and thus score poorly in terms of satisfaction for some. For homes in particular, concentration, location, and liquidity risks are all worth considering, since homes often hold a fair amount of your net worth, aren't very easy to move, and aren't as quick or easy to sell as something like a stock is. For stocks in particular, income uncertainty, horizon risk, and loss of principal are worth considering. If you're investing for retirement, longevity risk is also important to take into account. Lastly, let's talk about some perks of investing in the stock market as well as your home. The stock market may not give as many tax-related perks as real estate, but there are still some out there. First, assuming you hold your investment for longer than a year, your profits are taxed at the capital gains rate instead of the often much higher ordinary income tax rate. Second, in certain situations, you can lower your taxable income by selling investments that have lost you money. This is often referred to as tax loss harvesting. Third, generally speaking, you're not going to be taxed on your investments in the stock market until something is sold. This allows you to potentially defer paying taxes on the majority of your investments for a considerable amount of time. And speaking of deferring payments for taxes for a considerable amount of time, stocks have a fourth tax-related benefit. They are very easy to combine with tax-sheltered investments, such as a 401k, IRA, and HSA, which can lead to considerable tax savings without sacrificing the use of your standard deduction. To give you an idea of how big this can be, consider a married couple who both max out their 401ks at work, as well as IRAs and an HSA. They could lower their taxable income by about $57,000 while boosting their retirement savings at the same time. In addition to those deductions, they can still take advantage of their standard deduction of $24,400 a year. In total, this would lower their taxable income by a whopping $81,400. Assuming they were in a 24% tax bracket, that would save them around $38,000 for the year in taxes. And I'm only counting the standard deduction in there as savings because most homeowner-related tax breaks require you to itemize, which means you lose your standard deduction. So this will give us a better amount to compare to the potential savings of real estate tax breaks. But beyond the tax benefits, there's also at least one lifestyle-related benefit to consider. Stocks require very little work on your part to generate returns. It's one of the most passive ways to build wealth out there. Once you've done the initial work to invest the money, you get to just sit back and watch it grow. This can be particularly attractive to those with active lifestyles. But with that being said, let's take a look at some of the perks of homeownership. Tax breaks for homeowners may not be quite as enticing as they were in years past, but you can still get tax breaks in a few areas. The most common ones fall under a few categories: spending deductions and income deductions. Beyond that, there can be some lifestyle-related perks that are definitely worth considering. But two of the most common spending-related deductions are the mortgage interest deduction and the property tax deduction. According to the current tax laws at the time of this writing, you can deduct the interest you pay on the first $750,000 of your mortgage. So say if you had a mortgage of $750,000 with an interest rate of 4.5% and a 30-year loan, you'd pay about $33,500 in interest during the first year of the loan. You could deduct these costs from your taxes, but with each year that amount would of course decrease since you're paying off at least part of your mortgage as you go along. And as I said before, you would have to give up your standard deduction in order to do this. Assuming you were in a 24% tax bracket, this deduction would save you about $8,000. For 2019 at least, your total tax deduction for all state and local taxes, as well as sales taxes and property taxes, is capped at $10,000 per year for married couples, and $5,000 a year for singles or those filing separately. So assuming you somehow manage to pay no state, local, or sales taxes throughout the year, you could deduct up to $10,000 of your property taxes. And again, in a 24% tax bracket, that would save you about $2,400. However, if you either made or spent enough money to have state, local, and sales taxes of $10,000 or more, you would get virtually no additional benefit from your property tax expenses. Beyond expenses, there are also potential income-related deductions to take when you sell the home through the capital gains exclusion and the 1031 exchange. The capital gains exclusion allows you to exclude the first $500,000 worth of profits from the sale of your home from capital gains taxes for married couples, and $250,000 for singles. The 1031 exchange allows you to defer paying taxes on the profits made from the sale of your home under certain conditions. Generally, these conditions relate to how long you've lived in the home and if the new property you're using the profits to buy is considered to be of like kind and of equal or greater value to the home you just sold. There may be some other potential deductions depending on your situation. Some examples include PMI deductions, various energy-efficient home improvement deductions, and home office deductions, but I felt that these were some of the most common ones. If you own a home, be sure to speak with a tax professional to figure out what breaks are relevant to you. But real estate's perks don't just limit itself to the financial and tax realm. There's something to be said about lifestyle-related perks such as the increased privacy, space, pride of ownership, and the fact that, unlike stocks, you can live in a home. The average size of new apartments in the United States was about 941 square feet, according to rentcafe.com. The average size of a new home is about 2,641 square feet, though this is inflated a bit by extremely large homes. The median size of a home is about 2,436 square feet. But either way you slice it, that's a lot more space to roam around in. And I don't think I even need to explain the difference in privacy and pride of ownership from a home to an apartment. If you've ever lived in both, you've either felt the difference or you didn't. So is your home really a good investment? Well, it largely depends on your situation and what you're going for in an investment. And of course, what you're comparing your home to. Dollar for dollar, from a purely financial perspective, the stock market has generally had better returns historically, at least over the long term, and those investments usually cost less to maintain. They both present their own fair share of risks and each have a few unique perks to call their own, which could sway you one way or the other. At this point, you just have to look at your home and ask yourself, is it achieving what you want it to achieve as an investment better than the alternatives? If it is, then yeah, it's definitely a worthwhile investment. If not, perhaps now is a good time to take a closer look at those alternatives. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.